My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job's not just to entertain, but put days like today into context, because they're crazy. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Maybe it is just time for others to shine. That's how I feel about the new break in tech's momentum. The break that started with Salesforce 2 days ago, then accelerated yesterday with disappointing reports from several software companies. And Dell, the gigantic hardware supplier and integrator. Yep, the tech-laden NASDAQ spent most of the day getting slammed before finishing down just 0.01% thanks to a crazy town late afternoon run that we're all trying to get our heads around. But the Dow soared 574 points. The S&P gained 0.8%. Not bad, huh? Both, again, aided by some wacky end-of-the-month buy program that was invisible to all but those who jammed it through. The jarring nature of the tech sell-off took people by surprise, sent them scurrying far afield, including the stocks of companies that seemed to have done nothing. And then at the end of the day, with the buy program, finished up huge, startlingly up surprising levels. Didn't seem right to me, but that's what happens. I think there will be soon seller's remorse for tech. Yeah, a lot of the tech selling seems overdone. Now, take a look at Salesforce. That lost more than 50 points yesterday. It was able to bounce 16 points today. Dell, which had run up tremendously for weeks now, got blasted for delivering an inline quarter. Well, guess what? It wouldn't surprise me if it can't recover, and maybe recover fast. But hardware companies like Dell, which are connected directly to NVIDIA and its AI efforts, may have more room to run versus the enterprise software plays that have had gigantic multi-year moves, often with little connection to AI. We don't think less of artificial intelligence regime if MongoDB, which is a database company, reports slowing and sees its stock plunge nearly 24% in a day. No! By the way, I like engineering software. I like engineering, period, more than I like enterprise software, which is just a wasteland right now. With that in mind, though, let's see what's on tap. Ha ha ha! Maybe it's a bid from Suntory for Samuel Adams. What's on tap? No, we're going to our game plan right now. Our game plan could reveal the direction of enterprise software as soon as Monday, when GitLab reports after the close. GitLab's a key player in another form of enterprise software, the incredibly hot DevSecOps, or development, security, and operations software space. Key teams that help build software applications. Now, there are literally dozens of these companies, and they've been rallying like crazy ever since the Fed stopped tightening last fall. GitLab reported a disappointing quarter last time, and it seemed, well, kind of one-off. Now I wonder if it wasn't a precursor to what we've seen in software this week, where company after company keeps saying customers are skittish and sealed deals are awfully hard to come by. Measured. We'll soon find out. Now, I have been a gigantic believer in the rebuilding of corporate America, especially in the construction of data centers, which is a big reason why I happen to like the stock of Ferguson. That's a company that supplies plumbing and heating, ventilation, and air conditioning equipment. We had them on not that long ago. I think it was a terrific way to invest in the infrastructure build-out. After the close, boy, talk about terrific investment. We got CrowdStrike. Now, this is the lone cybersecurity company that hasn't missed its quarterly projections, aside from Zscaler, which we're going to hear from later. CrowdStrike CEO George Kurtz is money. I bet you he does a great job. Hewlett-Packard Enterprises reports, too. We want to hear if this competitor to Dell, which, remember, was down really big today, is seeing any slowing or price cutting. You know, the weakness in all things data center today was painful, directly stemmed from Dell. Maybe HPE can instill some confidence again, and that's where that seller's remorse will come from. You'll want to be buying the tech stocks again in the data center if these guys have a good number. And then we have PVH, the apparel company behind Calvin Klein and Tommy Hilfiger. Saw its stock poleaxe last earnings season. When it comes to apparel, you know I like Ralph Lauren. Much more consistent time on our brand, especially ahead of the Olympics. Next, everyone's always talking about the changing habits of the working class consumer. We know that times have gotten tougher with higher interest rates and inflation still running. Well, you'd think the Dollar Tree would be crushing it in this environment, wouldn't you? But it hasn't been. Instead, it's a victim of higher prices and suboptimal management. I keep thinking Dollar Tree will turn, but somehow the value proposition seems to be waning. When I go to my Dollar Tree candy aisle this weekend, I'm going to give you a full report on Monday about what it was like. Now, Campbell's Soup Yes, CPB has been holding up rather of late, and I wonder whether it's seeing some deflationary inputs that could give him an upside surprise. I think CEO Mark Klaus has made the best of what just kind of an okay situation. I believe in him. I believe in the company. I think it's on solid footing. All right, what killed whiskey and bourbon? Was it the cannabis? Was it the GLP weight loss drugs? Was it those doctors who keep telling you can't be a heavy drinker anymore? All right, whatever it is, let's hope this time around Brown-Forman, the maker of Jack Daniels, and all those other ones like the Tennessee Honey, Jack Daniels, all that stuff. And what is with the Fireball? That's not them, but what is with the Fireball? I mean, enough of the Fireball. I mean, it's like Captain Crunch. All right, anyway, I can't recommend the stock till we figure out what the heck is going on with liquor that people have stopped drinking the Browns and the Clears, which is vodka and gin and whiskey and bourbon. Oh, and then again, of course, we want to find out whether Centauri has decided that it's time for Brown-Forman to finally stop going down. Speaking of stocks that won't stop going down, how about Lululemon? Yes, Lululemon reports after the close, and this stock, which had once been a superstar for ages, now feels like it's wearing cement galoshes while swimming in the East River. Now, we know there's some turmoil in other companies that have crowded into the athleisure space, but what matters is whether all the bad news we keep hearing is already baked into Lulu stock. Hey, don't forget, by the way, that Friday's thing where you don't work, that's over. People come into work. They don't come to work at Lulu, all right? They don't. And if you do, you ought to rethink your apparel. When we've seen these stocks and they seem to not know how to bottom, they often make a stand when they report. But trying to bet on that is a harrowing experience. I'm not going to recommend it unless you got nerves of steel, tungsten. While we're on the subject of stocks that don't seem to know how to borrow, I am shocked. I am shocked at J.M. Smucker. It can't seem to find its footing. I think that the near 4% dividend yield might create a bit of a floor, but Smucker needs to find something to make them grow faster. I wish they ought to merge with someone. I'll get back to them. I'm beginning to get a little nervous about next week because now we're starting to see companies I've just mentioned, not so good. DocuSign. DocuSign reports, I keep thinking they're going to show us something that's going to reignite that growth. Rekindle our love affair with the company that made it so much easier to close business deals or real estate transactions. I'm just glad it's not up to me to figure out how to turn this thing around. Sometimes I just wish DocuSign would merge with the other big COVID play, that struggling post-pandemic Zoom. ZoomDoc, DocuZoom. You get me, right? Makes sense. Finally, on Friday, we have the most important story of next week, at least when it comes to the economy, and that's the Labor Department's non-farm payroll report. How funny is this? Help wanted. No, I want to be really clear on this. The Fed will feel no pressure to cut rates until unemployment reaches the 4% level. The Fed needs to see people lose their jobs while wages stabilize. Until that happens, they can't take action. We can talk about them taking action, but they won't. It's just that simple. I have no idea how we've all gotten so fixated on the outputs of the labor market. We're always going to have all sorts of inflation for all sorts of things as long as the economy's at full tilt. I don't want to root for job losses, but historically, throwing people out of work is really the only tool the Fed has to fight inflation. When people get fired and businesses close, when the apartments, the rents, the homes get too expensive, and the people in their 20s and 30s get laid off, you know what they do? They move back with mom and dad. They can no longer afford to live where they're living. They may not be able to pay for their cars anymore. They don't take out insurance anymore. They become what I'm calling walking deflationistas. I coined that just now. But that won't happen until unemployment spikes. I have no idea how we got to all the CPI price deflator roller coaster. What is that about? Enough, Magic Mountain. These changes are determined by Friday's numbers. So the bottom line, those of you who want the Fed to cut so badly that you're staying on the sidelines until they do, you better hope we get some weakness in the employment numbers next Friday. Otherwise, I'll tell you what, see you in July, Chief. Let's go to Kathy in Connecticut. Kathy.
Thank you, Professor Cramer, for taking my call.
Aye. What's up?
I need some help with Pfizer. I don't know what to do. Sell it? Hold it.
No, at this point, look, I think that we're going to see some results from CJ. Remember, they bought Seattle Genetics. Pfizer's got that yield. They're paying a weight. It's kind of like a CD with maybe some upside. Okay, how about Mike in the Illini? Mike!
Jim, how are you?
I'm good, Mike. How about you?
I'm doing okay. I talked to you 2 weeks ago. You told me to buy more of this enterprise software stock, and then the last 2 days, they've all been getting crushed. And I'm wondering what you want me now to do with ServiceNow.
All right, ServiceNow, I think that may be the exception. ServiceNow could be an exception. We don't know. I mean, they've got that rule, they got the rule of whatever, and they're doing terrifically. They're like up to Rule 90. Rule 9. They have not missed. They have made, and by the way, I made a comment the other day about Jensen and wanting to get with Jensen. They may be the only guy, I swear, they may be the only one that if you go to NVIDIA, you might see a ServiceNow button. I kid you not. There. Now, if that's straightened out, look, if you're sitting on the sidelines waiting the Fed to cut rates, then you better hope we get some weakness in next Friday's jobs report, okay? Otherwise, I'll see you in July. On Mad Money tonight, Zscaler reported an earnings beat last night and jumped higher in today's tape. I'm seeing if the stock can keep moving towards the clouds with its AI developments and recent acquisitions when I discuss the CEO. Then, can Gap's new leadership keep delivering? I'm diving into the comeback story after the retailer's incredibly great report. And the investment club, we hosted a monthly meeting yesterday, and we still had so many questions that we wanted to get answered that we're going to give you a taste of the club right here on Mad Money. So I suggest you stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.